All right, so we're going to pick it up where we left off last time with our discussion about options. I do want to mention that I think our first programming assignment, I think it'll be based on the Black-Scholes model, which is in the next section. And we'll be getting to that very, very soon. So in the next couple of days, I'll be sending out or posting um, a document which shows you exactly what you should be doing. And so what we're basically going to do is take the Black-Scholes model, which we'll be starting out by implementing it in Excel, and then we're going to extend that into VBA. And the advantage of doing it that way is that the VBA is a little bit more powerful and flexible than Excel. And so what you can do then is write code so that you can price many different options very quickly, or else more complex options. So I'll put this all together and then I'll post it in the next couple of days. But once we get into the Black-Scholes model, I think that would make sense to be our first assignment because it's something that you can see we'll be doing in Excel, and then you can basically convert that into VBA. Okay, I think that's a good place to start because then we can learn the structure of the language, what needs to be done, whether we're using a subroutine or a function, that type of thing. And we'll see all the different possibilities that we have available to us. So for now, we'll just keep going with the new material. But once we get into the next section, which is section 6, Black-Scholes option pricing modeling, then we'll have our first actual assignment. Okay, so anyway, why don't we get back into our discussion about options? And remember, last time we left off here, where we noted that all the information we looked at up to this point was based on the perspective of the buyer of an option. But of course, we can't neglect the sellers. All right. For every buyer, there has to be a seller. And so we have to consider now the payoffs and the profits to the sellers of these options. Now, before we do this, I want to point out that no individual is required to only be the buyer or the seller. You can actually do both at the same time. And in fact, often trading strategies that we'll be looking at today involve doing some of both. In other words, you might buy one option, you might sell another, and create a position that you hope will either make you money if you are correct about the future direction of market prices, or else it will give you a way of customizing your hedging strategies to your particular situation. So unlike with insurance companies, like when you buy insurance, you've got customers who buy the insurance and you have regulated insurance companies who can sell it to you. Nobody can really do both. Either you're a buyer, you're a customer, or else you're an insurance company who's selling. Okay, here we don't have that distinction. Every trader in the market, every investor, every market participant can do both. What we do have to point out here, though, is that the selling side is very, very risky because unlike the buying side where your losses are limited, on the selling side, your losses are unlimited, your potential losses, I should say. So when traders are selling options, they're typically also buying other assets, other options, other securities to help offset some of the risk. It's very rare that somebody would actually just sell an option because it would put them in a very risky position. So here's the sellers, and what we're going to see here is that in a lot of ways, their positions are the reverse of the buyers. So now, of course, what that means is, remember, we did say that when we were looking at the buyers of the options, they had unlimited potential gains and limited potential losses. Here, everything is in reverse. Your gains are limited. Your potential gains are limited. Your potential losses are unlimited, which is a pretty terrifying thing when you think about it. In fact, I think I may have already mentioned this. This is one of the ways in which poor Nick Leeson at Barings, managed to lose so much money. He lost over $1 billion for Barings Bank, which put it out of business because he was stubborn. He took a position which he thought was right, and when the position started to deteriorate, instead of unwinding it or doing something different, he decided to double down on it, thinking, well, I'm going to be right in the long run. But there's an old saying that the markets can remain irrational longer than you can remain solvent, which basically means that no matter how right you are, you can still lose a mountain of money. Okay. And that's what happened to Nick. So, all right, anyway, now what is the point of being a seller if you're facing all this terrible risk because you're the one who collects the premium? All right. So when I buy an option and pay that premium, it goes into the pocket of the seller. Just like an insurance company, when I pay for my insurance policies, they're the ones who keep the money. And of course, they invest it. And insurance companies are always looking for ways to manage their risks because they really are, when you think about it, in a very risky position. I mean, when you think about it, the amount of money I pay to my insurance company for my car insurance is not a huge amount of money, but they're potentially liable for the up to the full value of my car. So if I pay them some small amount of money every month, tomorrow, if I have a horrible accident, they might owe me $20,000 to fix my car or replace it. So, there's a lot of downside potential for them. So, in fact, there do exist companies called reinsurance companies, where insurance companies who are afraid that they have too much risk, they can actually sell some of it to the reinsurance company. It's a way of laying off some of their risks. They can't just walk away from all the contracts they've signed, but what they can do is transfer ownership to the reinsurance company because they may think, for example, they have too much exposure to bad weather in Florida, let's say, or something like that. So, with options traders who are selling options, they also will be thinking about ways to minimize their risk by taking other positions to help partially at least offset this risk that they're facing. All right. Well, anyway, so with all that being said, let's take a look at what's going on here. So first things first, the payoffs. Right. So these are the sellers or writers. So just a quick reminder for the buyers. Oops, I forgot this was on green. Okay. So in other words, just as a quick reminder, these are the positions of the sellers or writers. When we're looking at the buyers, if you recall, the payout profiles look like this. Just so you can see them all together in one place. So if you look carefully at them, you'll see that the only difference is this negative sign. That's because whatever payoff goes to the buyer, it comes out of the pocket of the seller. So if the call buyer has a payoff of $10, that means the payoff to the seller is minus $10. Same thing with the put. So the payoffs to the two sides have to add up to zero. They're mirror images of each other. And we'll see that when we draw the graphs. Now, of course, the profits and losses also have a major difference too. Once again, it's the sign that's different because now, as I said before, these are the people who are collecting the premiums. So once again, here's the seller's position. The buyers, if you recall, oops, we have this and this. And these would be our buyers. So again, it's the signs that are different. So that the profits and losses, again, if I make $5 from my position, the seller must be losing $5. So the two always add up to zero. These add up to zero. These add up to zero. So when you sell an option, what you're essentially doing is saying, I'm collecting the premium, but I'm hoping that the option never gets exercised. Just like an insurance company, of course, what do they hope? That you never crash your car and nothing ever goes wrong. But of course, they know that it will eventually. But they're hoping, they got their fingers crossed that you just don't have an accident. Okay, you can't control that. The only thing they can do is refuse to sell you a policy if they think you're a terrible driver. But other than that, once they sell it to you, um, they have to keep taking your premium, and then they have to pay out any problems that you have. Oh, for God's sake. Okay. So now we're going to look at the profit and loss diagrams. So let's start with the payoffs. Now, here's a payoff to the seller of the IBM call option we were looking at previously. And again, there's that negative sign. So if you notice, the option is still out of the money here. It's in the money, or sorry, at the money right here, and in the money down here. That doesn't change, by the way, even because it's a seller. The in or out of the money depends on whether the stock price or asset price is above X, at X, or below. But the payoff is exactly the opposite for the seller. So if you notice, these are always zeros. But here, these are the negatives of the payoffs that we saw earlier for the buyer. So what is that going to look like on a graph? Well, this is the payoff. Now, let me just quickly sketch in here what it looked like for the buyer. All right, it could be a little straighter, but that's even a little better. All right, so in other words, remember, this is the strike price. This is zero. So you basically flipped the payoff profile for the buyer upside down. Okay, so in other words, when the option is out of the money, the payoff is zero to both sides. Once we get into positive territory, when S gets above X, the payoff keeps going up for the buyer and down for the seller. And you can see now, and this arrow can go down forever. In other words, if I buy this IBM stock and suddenly they discover some amazing thing that they've been working on, and the price of their stock goes through the roof, the seller of this option, or sorry, the seller of the call option to the buyer is going to lose an awful lot of money, probably way more than what they collected on the premium. Their loss percentage could be hundreds of percentage points, or even thousands. The buyer, of course, well, they either make nothing or the worst thing can happen is they do not cover the call premium. On the upside, there's no limit to how much they can make. Now, of course, we do have to take into account the call premium. The seller is collecting the premium after all. So what that does is it adds $3 to their profits. And so the shape of the graph hasn't changed. It just gets shifted up by $3. So here's our maximum profit up here. Here's our break-even point, which is X plus C. And then it's all downhill after that. That's right. And once again, I'll quickly remind you what this looked like for the buyer. There's the point where the graph starts turning up at 50, the strike price, and then the break-even point is 53. So here's our maximum loss, which is $3. Three. And this is the call buyer. And this is the call seller. Again, so once again, it's just been flipped upside down. All right. Now for the put, remember we also had a put for the IBM stock with the strike of 50. And so once again, up here, the option is in the money. Oops, let me fix that. Here it's at the money, and here it's out of the money. And of course, oops, sorry, out of the money, which means the payoff is, and out of the money and at the money, the payoff is simply zero. Up here, this is the negative of the payoffs we had when we were the owner of the put option. Okay, and that's because this negative is here. So if you took the two charts and set them side by side, you'd see that, and you added them, or imagine if the same person owns the call and has also sold one for some bizarre reason, all the payoffs would be zero from that position. They have to add up to zero. And this is, yeah, this is the graph of the payoffs. Remember what it looked like for the buyer? And here's our put seller. Once again, the buyer's position has been flipped upside down to get to the puts seller's position. But now again, we're going to take into account the premium that we received by selling this put, which was $2, if you recall. So we added $2 to the payoffs to get to these profits. And here's the final result. Here's your maximum profit of $2, which simply means you're collecting the premium. And then, of course, here's our break-even point, X minus P, which is 48. And then after that, it's all downhill, except here there is a cap on our losses if the stock price goes to zero. That's as bad as it can get. Okay. And of course, you recall from the buyer's perspective, okay, this is our maximum loss of P dollars, which is 2 in this case. Okay, so again, you would never likely see anyone simply selling a put and letting it go with that, and having no other positions because of all the risk involved. Most likely, the seller of this put already owns the stock, or else has a position in some other assets that would offset some of this risk. Because as you can see, it's just too horribly risky. You might find people who have bought options and have no other position. Like you might find somebody who buys a call on the IBM stock, but doesn't necessarily own the stock. But with the puts, it's the sellers, it's very different. They really do need some way of hedging their risk, because otherwise they're really asking for trouble. Okay, so anyway, now with all that being said, we have the 4 basic positions. We can be the buyer of the call and the put. We can be the seller of the call and the put. But there's nothing to stop us from doing other combinations of these options. For example, I could buy 2 different calls, or I could buy 2 different puts, or 3, or I could sell any number of these calls and puts, or I could buy some and sell some. So in other words, what we're building up to here is the idea that we can create specialized strategies by combining these different call positions, option positions, both in calls and puts. In a way, what you're really doing is almost like working with Lego, is you start with the basic bricks and then you build up to the very complex structures. It's kind of the same idea with options. And you'd probably be surprised when you see some of the positions that can be created with options. Many of these would be impossible with the underlying securities like IBM stock, or with forwards or futures. Okay, those are very straightforward securities. These give you a lot of flexibility, and you'll see some really surprising results here. So the basic strategies that we'll be considering here fall into 2 basic categories: spreads and combinations. Now, of course, there's plenty of others too. We're just going to look at the basics. But really, when you think about it, the sky's the limit with these strategies. Really, you can create any type of hedge you want. You can create any kind of a speculative position, but these are the standard ones. So what separates spreads from combinations is that with a spread, we have only calls or puts. Okay, no matter how many of them there are, they're either all calls or all puts. We don't mix them together. Now, if I'm going to be buying multiple calls, though, they have to be different somehow. In other words, I certainly I can buy as many calls as I want on IBM stock with a strike of 50, but to create a strategy, the other options in my position really need to be different in some important way. And that way is often the strike price. Um, like I might want to take a position in IBM call with strike 50 and another one with strike 55, let's say. So now I also could buy calls with different underlying assets or different maturities, but that gets very, very messy very quickly. Most of the strategies you'll see, if there are multiple options involved, you typically are written on the same asset, but they have different strike prices. Okay, it's not impossible to do something else, but we're going to stick here with all the cases where the only difference between the options is the strike. Okay. Now, here's some cases that we'll be looking at. Now, sometimes the names of these things are helpful and help understanding what they are all about. Sometimes they're not. Okay, it depends. So here you can see we have a bull spread, we have a bear spread, which could alternatively be called, as we'll see why in a minute, a reverse bull spread. And then finally, we have a butterfly spread. Now, the names, like I said, they can be helpful. These two are because if you recall, if you're bullish, at least with respect to investments, that means you're optimistic. If you're bearish, that means you're pessimistic. So a bull spread indicates that what you're doing is you're essentially setting up a position that benefits if the underlying asset price goes up. The bear spread means you'll benefit if the price goes down. A butterfly spread is a very interesting concept. We'll get to it in a minute because it's a little bit different than maybe what you're expecting. But the bull and the bear spread are enabling us to set up a position on the direction of the asset's price. Okay. Now, of course, we'll take the position that makes sense for us. In other words, if you're really optimistic about a stock, you might want to set up a bear spread. Sorry, a bull spread. If you're pessimistic, you might want to set up a bear spread. So the bull spread is set up by doing the following. And by the way, this can be done with either two calls or two puts. If we use the two calls, it's known as a bull call spread. If we use two puts, we call it a bull put spread. By the way, it just suddenly I remembered now. I have a document which I found on the internet, which I think I'd like to add to Blackboard because hold on one second. I used it in another class last fall. Oh, wait a minute. And so I thought, oh, this looks. Wait a minute. What am I doing? I keep going. Here we go. Where is it? Oh my God. No. Well, all right. I thought I knew where it was. Maybe I can find it on the internet. Yeah, see, there's all kinds of online stuff here, but Options Industry Council. All right, I'll find it. It was basically a document that basically had a list of some of the very popular strategies you might see on Wall Street. I'll see if I can find it. But remember what I did mention the other day that if you go to the CME website, they do have their own educational materials. And if you decide, I really want to get more deeply into options, oh, it's here. Oh, don't you worry about it. It's here. This is something we'll be looking at very soon. Options delta, the Greeks, those are risk measures. Oh, there's so many. Look. Yeah, it looks like they're starting out with only futures contracts and then they'll work their way up to the options. There's theta. That's another risk measure. Either that or they're not the butterfly spread. We're going to look at that today, but they have their own materials here. Here's their discussion about another risk measure. And so it's all right here if you want to look at it. It's completely free too. Anyway, let's begin with this bull spread. So the key here is that you're buying either the call or the put with a low strike, and you're selling the same option except with a higher strike. So in other words, it's important to make sure that it's the same option, the same asset, the same maturity, and it has to be the same type, call or put. But what's different, the only difference is that the one you're buying has a lower strike price than the one you're selling. And you can see, as I said before, the same individual, the same trader can be both a buyer and a seller. Okay. It's not the case that only some people are allowed to sell. It's just that everybody can do both. But here, the risk of selling the call, the high strike, is largely offset by the buying of the strike, the call with the lower strike. So the net position is actually not that risky, but you still will benefit if prices go up. All right, so yes, and so you got the two different names depending which one. We're going to just stick with the call positions, by the way. The only thing that really changes with the put positions is the cost. The prices can be different. In a lot of cases, puts can be cheaper than calls, and it can affect the payoffs. So going back to the original example we had of European call, strike 50, and price of $3, let's assume that there also is available to us a call in IBM where the strike is 53 now, and because the strike is higher, the cost of the option is lower because it's harder to make money when the strike is higher like that. So in other words, the second one is cheaper because the price of the IBM has to go above 53 before we get a positive payoff. So naturally enough, that means that this call is cheaper than this one. All right. So what we're going to do is put them together. First, these are the payoffs. So I've got the 50 strike call, which is X1, by the way, is the strike of 50. X2 is the strike of 53. And if you notice, there's that little negative there because we are selling this one. And so this first one is out of the money here, at the money here, and in the money here. Whereas this one, it's out of the money all the way down here, at the money here, and it's only in the money for these last two. So, and by the way, this chart on the left, those are just a bunch of different possible strike prices. We could put them all in, but the chart would be impossible to read. So it's enough to look at these. And then here, all we've done is added them together. Okay. Now, if you notice something interesting, look at these payoffs. They aren't going to go below 0, but they're also not going to go above 3. That's interesting. Before, when we looked at calls and puts, we noticed that if we're the owner, there's a limit to how far the payoff can go down, but not up. But here, all of a sudden, there seems to be a limit on how low the payoff can go and how high it can go. Interesting. Now, this is the diagram. Now, this is kind of an art, learning how to take a pen and actually draw these graphs. You're seeing here the net result of the two positions. Drawing them both individually can get very messy, but if you put them together, this is what it looks like. And if you notice, there's two places where we have a change in the slope, x1 and x2. So here we have a payoff of 0 because both options are out of the money. Here they're both in the money. Okay. And then within this range, only the first option is in the money. And so what's happening here is that the payoff is 0 here. Up here, it's 3. And here you have a slope of 1. So basically what it looks like is a call option with an upside limit on its payoff. So why do we want to be in this position? Why don't we just buy a call in the first place? Look what we're giving up here. By the way, if you remember, the call prices were 3 and 2. We bought a $3 call and we sold a $2 call. So the price of buying this position or setting it up is $1. Okay, so in other words, C1 is 3, C2 is 2. So the cost of setting up this position is actually 3 minus 2, which means 1. And so we're subtracting 1 from all of these payoffs to give us our profits. Again, if you notice, there's a limit. That's the maximum loss. And here's our maximum profit. So we're going to be bounded between, here it is, a loss of $1 and a maximum gain of $3. $2, sorry. Wow. And the break-even point is X plus C1 minus C2, which is 50 plus 3 minus 2, which is 51. That's our break-even. So now here's the big question again, why are we doing this? If I just bought the 50 strike call like we did earlier, we would have no maximum profit. But here's the difference. The cost is 3, which means we can lose up to $3, but no upside maximum. The bull spread only costs $1, which is a third of the price of the call. But it does mean that our losses are limited to 1, but also our profits are limited to $2. So this means that this trader is expecting the price to go up, but not much past 53. In other words, they're willing to give up all this upside potential in exchange for a much cheaper position, because they're right. Making $1 profit on $1 investment is 100% rate of return. Making $1 profit on a $3 investment is only a 33.3% rate of return. So this trader is gambling that the price won't go up very much, and in exchange for that, we save a lot of money. So I would say that this investor is cautiously optimistic about the stock price, and therefore they want to take advantage of that by selling that second call, which limits their profits, but also reduces their costs. Okay, so there you go. So this person is thinking not just the price going up, but how high it might go up. All right, so very clever strategy if it proves to work. What if the price goes up to 60? Then they'll be kicking themselves because they lost all that upside potential. But on the other hand, if the price goes very low, then their loss is capped at $1 as opposed to $3. So, It's the kind of thing you would set up only if you're pretty sure that this is what's going to happen in the marketplace. Wow. Now, a bear spread, as the name suggests, is the reverse of the bull spread. I did mention up here that the word reverse, by the way, in this context means you're changing the signs. Okay, so in other words, we're going to do the opposite of what you see here. We're going to buy the high strike option and sell the low strike option. Why? Okay, let's find out. So yes, we're going to buy the high strike, sell the low strike. And again, it can be done with either calls or puts. Um, if we use the calls, it becomes a bear call spread. With puts, it becomes a bear put spread. We're going to stick with the calls, but you could easily do this with puts. So again, we have the same two options. We're just reversing which one we buy and which one we're selling. So now we sell this one and buy this one. Now, if you notice, that means the net cost of this position is negative $1. That means, in other words, you're actually putting $1 in your pocket to set up this position. So if both options finish out of the money, you just keep the $1. Huh, interesting. So in other words, the investor or trader pockets $1 to set up this position. Well, that's pretty interesting. You're actually putting money in your own pocket, but you have to hope that it works out for you. Now, here's the positions, and if you notice what's different this time is that the negatives, this one's negative, this is positive. So if you notice with the payoffs, the payoffs are bounded between 0 and negative $3. But remember, we get to keep that $1. So these are the profit. Sorry, these are the payoff profiles. I put them together so you can see that. Remember, we reversed the bull to get to the bear. So just like the difference between buying a call and selling a call, on the graph at least, it's flipped upside down. The same thing is happening here. The bull and the bear spread are mirror images of each other from top to bottom. Okay, because with a bear spread, rather, all you're really doing is selling a bull spread. Okay, that's how you can look at it. Or you can think of it as a bear spread. You can think of it as a reverse bull spread. Now, that doesn't look very appealing, but again, once you take into account the fact that you earned $1 from this position, you'll see that this is what it looks like. So here's your maximum profit. And here's your maximum loss. So this trader is cautiously pessimistic about the stock. They think it's going to go down, but not much below 50 because otherwise they're losing all that potential. So cautiously pessimistic. By the way, what's interesting here is that what if you decided to put them, if to buy one of each, you would create what's called a box spread where you would end up with a profit or loss that looks something like this. You basically be locking in a specific rate of return. And that return would be the risk-free return on your investment. Because the net cost, well, actually here the net cost would be 0, so you'd end up with 0. You have to. The thing about the derivatives markets is that when you set up a position that has no risk, you have to earn the risk-free rate of return in order to avoid arbitrage opportunities. But it can be done. Or now you might say, well, who would do that? But what if you already own a bear spread and you want to offset it? You can buy a bull spread. Okay. Rather than unwinding your position, you can simply buy a bull spread and then you're essentially canceling out the gas flows. Now, here's the most interesting one because it's something that is not done or cannot be done directly in the stock market and the forward contracts with futures. This is something that is really only feasible with options. Before we do that, I just want to mention this idea of volatility. Now, we all kind of know what the word volatility means. It means there's a lot of uncertainty. Okay. I mean, you can use it in even more general sense than that. Like if you say that the market for, let's say, gold is volatile. Actually, it is the same thing there. Because it means that you're not so sure what's going to happen with gold. Some days it goes way up, some days it goes way down. Volatility means there's a lot of uncertainty. And so if you have a statistical background, this is often measured in terms of the standard deviation of the returns to an asset. Okay, so volatility means if there's a lot of volatility in the market, it means we're not sure what to expect. And that's never good for investors. People don't want to be worried about what's going to happen tomorrow or next year. So sometimes the markets are in turmoil. There's a lot of volatility, and sometimes they're very calm and stable. Things are going well, and they're not so volatile. Now, interestingly enough, volatility is something that can't directly be observed. It's implied by options prices or market prices, but there does exist an index, which you may not have ever heard about. It's called the VIX, which stands for Volatility Index. Here it is. It trades on the Chicago Board Options Exchange, and it came out in, I think, the late 90s. It's something that was suggested by actually a professor of finance at Duke named Robert Whaley. He wrote a series of papers in which he said, we really should have an index that measures volatility that investors can pay attention to and even speculate on. And so if you look at this thing, that's just today. Oh, here we go. Here we go. So basically, this VIX index is derived from options on the Standard & Poor's 500. And it can go way up when things are rough. Like here at the start of the COVID, it went through the roof. And then when things got better, it starts to calm down. It goes through these cycles, okay, where it can go really high in a hurry if things aren't going so well, but it can also calm down. So you can actually buy options and futures options on this index. You can go to the CME and buy one. Now, why would you do that? Well, keep in mind that when things are going badly, volatility goes up. If you think that the economy is heading for a rough patch, but you're not sure which stocks are going to suffer, rather than trying to pick those stocks, what you can do is buy a put option on the VIX, which means that if it goes, sorry, not a put, a call, because you are then saying things are going to be bad in the near future. The VIX index will go up, so I buy a call on the VIX, which means I benefit if that actually happens. If I think things are going to calm down, I would buy a put because then that means the index will go down. So I'm basically directly betting on volatility rather than trying to choose individual stock prices. And it's a very powerful tool to have available to us. And so Whaley had a great idea there, and it's a very popular index because, again, it lets you speculate on the future direction of volatility rather than stocks themselves. Okay. Now, with all that being said, what we're about to do with the butterfly spread will presumably make a lot more sense because the butterfly spread is also a position on volatility that we create ourselves out of individual options. So now this sounds very complicated. A butterfly spread is creating, again, because it's a spread, it's either all calls or all puts. Either we buy an option with a low strike price, we buy another one with a high strike price, but we sell two with an intermediate strike price, two in the middle. So now remember, now all of these are written on the same asset. They have the same maturity date. What separates them is their strike price. So we buy a low, a high, and sell two in the middle. Why are we doing this? What is this getting us? Well, all right. So now let's assume that besides the other two options we were looking at earlier, there exists an European call on IBM with a strike of 47, and this time the price is 5. So here, now these are the two we had earlier when we were creating the bear and the bull spreads. This is new. And if you notice, with a lower strike, any option will be deeper in the money, and therefore that call has to be more expensive. So wait till you see this graph. It's going to be very difficult to visualize this before you actually see it. So here we go. Now look at this. Here, remember, this is 47. This is 50. And this is 53. So here you buy it, but ooh, look at this one. That's different. Not only is it negative, but it's -2 because we sold two of these call options. So we have to double the payoffs and make them negative. So when you add these up, this is what you get for your payoff profile. Now here's an interesting twist. It goes from 0 up to 3 and then all the way back down to 0. What's going on here? Well, when you look at the graph, you'll say, that is very interesting. And if you notice, here's the low strike, here's the high strike, and here's the intermediate one. Wow, it's like a big tent. Now, why this reminded traders of butterflies, I don't know. Maybe it has wings, who knows? Now, how much did it cost us to buy this position? Let's see. We had to pay for C1 and C3, but we collected the premium from C2. So it's going to be 5 plus 3, 2 rather, minus 2 times 3, which is 7 minus 6, $1. This position only costs us $1. So when we include that in our calculations, this is the result. Okay, so again, here's the strike. There's another strike. So on either side, we have two, the maximum loss occurs here and here. We have a couple of break-even points. So let's see, this one is X2. Oh no, it's X3 minus C1 plus C2 minus 2C3. Oh, sorry. Wait a minute. I'm making a mess out of this. Okay. So anyway, what has to happen for us to make money? So we have to stay, the stock price, yes, the stock price stays close to X2. In other words, it doesn't change very much. We're hoping that the stock price, we don't really care if it goes up or down. It almost doesn't matter. As long as it doesn't move too much, we'll make money. Okay, so if we're assuming that the stock price is currently 50, if it stays right where it is, we'll have our maximum profit. If it doesn't go up by more than $2 or down by more than $2, we'll still make money. So in other words, what you're seeing here is a bet on low volatility, or you can think of it as a bet against volatility. Okay, so we're not betting on the direction of the stock like we did with bulls and bears. We're betting on the volatility being low, meaning that the price will hardly change at all. Like imagine yourself in a sailboat and you're betting that there won't be any wind today, that kind of thing. So I guess in that case, if you're really a sailor, if you had a boat that has a sail but also an engine, on a day like that, you would bet against the wind by bringing gas on board in case you need to use your engine. Okay, now what if we expect a lot of volatility? Then we just do everything in reverse. Okay, we sell the low strike, we sell the high strike, we buy the two in the middle, and this becomes known as a reverse butterfly spread. Sorry. Reverse means we're changing the signs of our position. We also know that that means the graph will be flipped upside down. So, and we can see, and also, by the way, this one provides us with $1 in our pockets when we set it up. So this is what it looks like now. So this is the one where we're betting on volatility. We want the price to go up as much as possible or down. We don't care which one it is. Either way, we'll make money as long as we get past the break-even points, which are 48 and 52. So this is a bet directly on volatility. So I'm setting this up because I believe that things are going to be tough in the markets in the near future. Something's going on. There's some scandal in Washington, or there's some disaster going on Wall Street, or the market is having a rough time. And I don't know what's going to happen, but I do know that prices will change quite a bit. So or imagine this scenario. Imagine if this stock is, let's say, Pfizer. It's a pharmaceuticals company. Tomorrow, they're about to announce that either the FDA approved their new drug or they did not. The FDA says yes, the company will make a lot of money and the stock price will go way up. And the FDA says no, they'll lose a lot of money and the price will go down. I don't know which one it's going to be, but either way, I'll make money if I've set up a reverse butterfly spread. Okay. Whereas up here, you're saying, well, I'm pretty sure that nothing exciting will happen with this company anytime soon. So I'll just buy a butterfly spread because I expect the price to sort of just float around where it is now. Now, you can never do this with any other type of security in the marketplace. Only options make this possible. All right. So this is one of the ways in which options are far more powerful as hedging and speculation tools than forwards and futures, where you're basically restricted to betting on the direction of the price and the asset itself. Same thing, you're betting on the direction of the asset. Here, you can actually bet on the volatility. So that's a huge deal. Wow. Now, that's all we need to say about spreads. There's a million of them, but these are the three we wanted to focus on. Combinations means we're combining at least one call and at least one put. Again, the same asset, the same maturity, the same everything, but now one is a call and one is a put. And here, the strikes don't have to be different. So with the straddle, this is the most important one. This is the one that really sets the tone for the rest of them. We're going to buy a call and a put that are identical in every other way. In other words, they have the same strike, the same maturity, the same asset. What is that going to get us? Let's find out. And here, we're going to go back and revisit. Now, remember, we've seen these before. We have a call, strike 50 with this price of 3, a put, strike 50 with a price of 2. We buy them both. And so here's the payoff profile. No negatives here because we own them both. We add them up. Now look at that payoff profile. It starts at 10 and it goes down to 0. And then it starts going back up again to 10. What is going on here? It's a big V. Now look at this. Is this even possible? Payoff is positive unless the price stays at 50. For all the other prices, the payoff is positive. Well, that sounds like a good deal to me. There's just one little problem. We bought both of these options. This is a fairly expensive position. The total cost of this position, remember for the others, it was $1 or $2 at the most. Suddenly we're looking at $5 now. Ooh, now once we take that into account, that does change it a little. See what's going to happen now. So we really have to move all the way up to 55 or all the way down to 45 before we start making money. So the expense of the position means that it's tricky to push it outside that range. But unlike the butterfly spread, remember there was a maximum profit on either side. Here we don't have a maximum. So it's harder to make money than with the butterfly spread. Sorry, the reverse butterfly spread. Let's go back and revisit it. Yeah, so you can see the difference. It's a V, but this one is capped at $1. This one is not capped. But look how far the stock has to move before you start to make money. $5 versus 2. Okay. So, which one do you set up? Well, it depends on what you think is going to happen. If you think this stock will be pretty volatile, but not crazy volatile, you might want to set up a reverse butterfly spread. But if you think the potential exists for the stock to go through the roof or through the floor, you might want to set up a straddle. So yes, you're betting on a lot of volatility here. Ooh, like crazy volatility. Like the company is either going to make a fortune or they're going to go bankrupt kind of volatility. And as always, if we have the opposite outlook, we can do the opposite by simply reversing our two positions. In other words, changing the signs, which in this case would mean we sell both the call and the put. And that puts $5 in our pocket today. Wow. This is called a reverse straddle. Again, you see how it's been flipped upside down. Now, unfortunately for us, though, this means that there's a maximum profit of 5, but there's no maximum loss. Ooh, so we're betting against volatility, but if we're wrong, we can really get clobbered. Okay. Oh my God. Now, remember with the original butterfly spread, there's a maximum loss. It's capped at $1. So you're basically saying we hope it stays in this region, but if it goes outside, we'll lose $1. Here, we could lose our shirt if it really goes outside that range. Wow. What if the price goes up to 100? We're really in trouble. Or down to 0. So this is a horribly risky. In other words, Because remember, we said before, selling a single call or put is very risky. Imagine what selling two of them is like. You're really getting into some deep waters here. But if you think you know what you're doing, there you go. Wow. So that appears to be the end of section 5. Actually, we have a couple of minutes left. Maybe we'll take a peek at 6. 6 is where we start pricing these options. Okay. And like I said, I mean, this is just the tip of the iceberg for strategies. I just wanted you to get a feel for them. Um, yeah, the possibilities are just, it's insane what kinds of things can be done here. But really our focus now, and really for the next few sessions, is all about pricing. So let's go get the section 6 notes. There we go. And at least take a look and see what's coming next. Okay, so we'll start with the basic Black-Scholes option pricing model. So this one gives us an excuse to have a bit of a history lesson. So I mentioned before, options have realistically only been trading in the United States with any kind of volume since 1973, and there's a reason for that, because nobody knew how to price them until that time. It turned out to be a huge challenge to figure out how to properly price options. So fortunately, in 1973, a path-breaking paper was published by three researchers, Fisher Black, Myron Scholes, and Robert Merton. Now, what happened was apparently Black and Scholes had started working on this idea, and then Merton came along and joined the team. When the paper was ready, they actually offered Merton to call it the Black-Scholes Merton model. And apparently Merton said, nah, that's all right, don't worry about it. He's a very humble man. But in a lot of textbooks, Hull's textbook, I think he does call it Black-Scholes Merton, because they really they're all three responsible for this model. So, and interestingly enough, in 1997, Myron Scholes and Robert Merton won the Nobel Prize in economics for this model. Sadly, by that time, Fisher Black had already died, so he didn't get the prize, but Scholes and Merton were awarded the Nobel Prize because of this model that they created. Now, when they published this paper, they had no idea how important this would turn out to be. They're academics. They're writing a paper. That's what academics do. I mean, they thought it was a good paper, but they didn't realize that it would revolutionize the field of finance, especially the field of derivatives, because for the first time it became possible to price at least European options. Later research was needed to develop a model for American options, but now all of a sudden it becomes possible to price European options. So they also established a framework for pricing derivatives that is used really in all derivatives pricing models to this day. Merton in particular was very good at math, and he introduced a very unique new form of math into this pricing model, which had not been used before. And so anyway, this is a huge deal. Ironically enough, now they published it in the Journal of Political Economy after being turned down by 8 other journals, which are now still kicking themselves over passing up on the original Black-Scholes model. It's like all those record labels that turned down the Beatles before they got to Capitol. It's like, okay, what were you thinking? So anyway, the Black-Scholes model, the math that's going on behind the scenes is really pretty scary looking stuff, but the model itself is easy to implement in Excel and in VBA. So that's what we're going to be doing. Okay. We're going to see how it's done in Excel, and then you'll have a chance to write some code and price these options in VBA. And it won't be that much of a stretch. The commands will be very similar from Excel to VBA. But anyway, so this is the starting point for everything that follows. Now, what's interesting is that the Black-Scholes model was only intended to price calls. What about puts? Well, this other relationship was developed called put-call parity, which is a no arbitrage relationship that shows the mathematical relationship that ties together the prices of calls and puts that are European and they have the same strike, asset, and maturity. So that made it possible to price puts as well as calls without needing a new model. So we'll be going through all of this good stuff in our next session. So in the meantime, we'll stop here, and I can see you're looking forward to this already, and see how to price at least European options. Okay, so I will see you then.